And I think, to Alistair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do it before the masses figure it out, like the way the central banks started doing this 5 years ago, 6 years ago, 7 years ago, and then the others being the sovereign wealth funds and the commercial banks, these are people at the highest level. So yeah, I would say it's everything. And to Alistair's point of the ETFs being expensive, yeah, you're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price. It is so expensive that no one mainstream reads it unless you are a institutional sized trader or hedge fund, running a hedge fund or whatever. These people at the top level are being given the acknowledgement, the wink of the eye, if you will, by the same banks that have been suppressing the price. At the same time, we've talked at length about, and I started my first couple podcasts with you in 2020, we talked about the others that showed up on the Commitment of Traders report, which there was always just two groups of reportables. The largest positioning in the Commitment of Traders report published by the COMEX were the hedge funds and the commercial banks. Then all of a sudden there's this group called the others. Who are they? They are sovereign wealth funds. They're central bankers wearing a different hat. They're friends. They're an offshoot, if you will, or family offices of tremendous wealth started standing for delivery, which I'm like saying to you, Dunnigan, this never happens. What, less than 1% have stood for delivery my whole career. At this point, it's been 30 years I've been doing it. Something's not right. And now we see it. Of course, we've seen it with almost 40 central banks repatriating their gold from the Bank of England and the New York Federal Reserve. Early adoption into backwardation right now. We see problems of getting the metal. Sorry, there's a 8-week delivery delay, folks. We have a shortage of manpower and trucks in London, we were told. Or, not really a good example, but gets the point across. Venezuela says to Bank of England, can we please have our gold back? No, you can't. And when you see 40 countries pull their gold home from the Bank of England and New York Fed, they were there because for many years you had the Western rule of law and stable, liquid, efficient markets, the COMEX and the LBMA. They don't care. And you're seeing exchanges, the Shanghai Metals Exchange and their expansion in multi-jurisdictional expansion, one being built right now in Saudi Arabia, one just completed in Hong Kong, which allows you to take metal off of the exchange through Hong Kong and receive it directly by trading yuan into it. The people who are doing this are the central banks, and they are the most well-informed traders on the planet. That's number one. Now it's moving to the commercial banks who are telling their institutional size clients, early adoption is everything. And this is why most people fail at investing, because they move rather than trusting their intuition and listening to the rants of a guy like me. What the hell do I know? Or Alistair, what do we all know? Well, we've been right. And we have been right. By hook or crook, we've been right. And, we were laughed at. And you look at an environment where Wall Street refuses to acknowledge it, but now they are at the highest level. But they don't tell you, yeah, we've been wrong. We laughed at all of you guys who wanted to buy gold and silver, yet it's outpaced the 10-year Treasury 2-to-1, doubled it. It's beaten the S&P 500 with dividends reinvested for 25 years, which, by the way, no one ever does. No one ever does reinvest all their dividends. But we are living in an environment of negative real rates, and you could argue yield suppression, where they're trying to keep the yield down best they can, monetization of assets. And this has pushed investors for a long time into risk assets, which have inflated valuations, like all the Mag 7. And it's hiding the risk. And that risk hiding, well, the insiders know. Why do you think they're leaving? As the public's chasing that FOMO. This isn't free market pricing at all. And the assumptions of return are off. You can't make these assumptions in this environment. And I think, to Alistair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do it before the masses figure it out, like the way the central banks started doing this 5 years ago, 6 years ago, 7 years ago, and then the others being the sovereign wealth funds and the commercial banks. These are people at the highest level. So yeah, I would say it's everything. And to Alistair's point of the ETFs being expensive, yeah, you're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what the hell is that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price down. It allows them to pull metal off elsewhere. But, you're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100. You got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central banks started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this. And at the same time, but that excluded the New York traders all this time until November of this year. And now those in the respect that a lot of what Alistair is talking about it deals with just this monetary inflation, asset valuation, the inflation adjusted value of bonds and equities. When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts of 2%, in fact, missed it by 50%, they call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me, but there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS. And we know that. We've talked at length. John Williams says inflation's 11%, shadowstats.com, not 3. So nominal returns, to Alistair's point, are an illusion when inflation certainly is higher than we think. But even at 3%, and they're trying to push rates down below that. But even say you get a 5% return, right now you're losing in real terms by John Williams' measurement, a negative 6% real return. And in that environment where you, to Alistair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alistair's points, in the bond market. And that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now,